Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at how cost of living pressures are showing up in ASX listed companies' earnings results. Wesfarmers CEO Rob Scott has indicated further rate cuts are needed to boost consumer confidence in the face of continued cost of living pressures. The retail conglomerate is expected to be a beneficiary of the RBA's first rate cut since the pandemic, as lower mortgage repayments boost disposable income. Wesfarmers cited strong trade across all its retail divisions in the first 6 weeks of the second half, after posting a near 3% rise in first half profit, which saw it able to boost its dividend. However, the Bunnings and Kmart operator has flagged domestic cost pressures are likely to persist, driven by labour, energy and supply chain costs, as well as weakness in the Aussie dollar.
We've demonstrated through Kmart, Bunnings, Officeworks, that we can find ways to try and mitigate some of these cost pressures. Because what we will be doing is doing everything we can to keep our prices low because of our everyday low price strategy. But I think we do need to be mindful that the lower Australian dollar, although it's good for a lot of our exports, will potentially create some inflationary pressure.
Despite cost of living pressures impacting consumers' disposable income, both the CEOs of wholesale chicken supplier Inghams and fast food restaurant Guzman are upbeat, saying people need to eat.
Something like 75% of Australian households consume chicken 3 times a week. So it is still a very popular household choice. And even in this difficult environment, we're seeing relatively strong retail sales, which is obviously purchases to support in-home dining. So our view is that the poultry, chicken in particular, has still got good growth prospects in the years ahead.
I'm not an economist, but people have to eat, right? They want high quality food at value, at convenience. And GYG, we believe, does it better than anybody else. So, if the economy's strong, the economy's weak, people are coming to GYG because it's high quality food, great value and great convenience. And obviously you can see it in our numbers.
And when it comes to those numbers, the food retailer's global sales increased 23% in the first half to $578 million across 239 restaurants in Australia, Asia and the US. GYG is expecting to exceed its full-year profit forecast and has seen Australian comparable sales growth rise 12% in the first 7 weeks of trading. The wholesale chicken supplier Inghams equally upbeat. Its first half profit did decline 19% to $51.5 million, missing market expectations, but the result reflected a decline in core poultry volumes as Inghams transitioned to its new supply agreement with Woolworths. CEO Andrew Reeves welcoming the recent rate cut by the RBA.
This week's rate cut was encouraging. I guess it's not a large cut, but hopefully it'll have an impact on consumer sentiment as we get into an easing cycle. And that one of the things that's been dragging on the category on poultry over the last 12, 18 months has been out of home or discretionary spending, which particularly affects our large quick service restaurant customers. So hopefully if that sentiment starts to improve and we are seeing some stabilising in those channels, then we'll get back to volume growth there, and that would be a really positive thing for the business as well.
Well, ASX TradeWatch data suggests Wesfarmers shares are in a strong bullish trend, most analysts suggesting holding the stock, which has an average target price of $71.72 according to Refinitiv, suggesting it could drop a further 7%. Now, when it comes to Inghams, the average recommendation on the stock also a hold with a $3.57 target price, suggesting it can add a further 3% from here. The average price target on Guzman is $40.57, suggesting a further 13% upside. Barrenjoey raised its price target on the stock to $54 following the results, while Morgans also sees further upside, upgrading GYG to an add following recent share price weakness. And analysts say further expected rate cuts could boost consumer staple stocks, but for now, there's no major reason to re-rate the overall sector.
I think if we go back to where the market was before Christmas, the market was not priced for a rate cut. It was a counter consensus call to have a rate cut in February. And that change is particularly through January, as we saw the lower inflation print and the retailers rallied very hard. So I think what we've seen through results season is you've had very strong expectations. Results have been okay, but they haven't been enough to really re-rate the sector higher. And I think that's a pause for, investors are taking a breath here. Just what is the pathway for rates? What is the next acceleration point? And I think for the first 3 weeks, it's not completely clear that it re-accelerates right here, right now. We're going to have to wait till the conference updates and the quarterly updates in April, in April and May.
And that is your IG macro intelligence for this week. We'll see you next week.